Article 7, Paragraph 2 of the India-USA Treaty. And this basically deals with how do you calculate the profits of a PE, subject to the provisions of Paragraph 3. Now, Paragraph 3 basically mentions that, what are the expenses which are going to be allowed to the PE as a deduction, right? So, subject to that paragraph which deals with the deduction of expenses, where an enterprise of a contracting state, let's say a US enterprise, carries on business in the other contracting state, India, through a PE situated therein, through a PE situated in India, there shall, mandatory, in each contracting state. Now, the use of the word each indicates that the allocation or the attribution that we're going to look at right now has to be done for both the states. It's not that there is an exclusive right with any of the states to tax such profits, right? So on a mandatory basis, there has to be an allocation in each contracting state, be attributed to the PE, the profits. Now, when we talk about profits, obviously it includes losses as well, right? So think of it like this. A PE is kind of an independent company. A PE is just like an independent company. It's just that it does not have a corporate form, right? So its profits are also to be calculated in the same manner as the losses, right? And in order to calculate the profits, the accounting methodology that needs to be applied is the normal accounting principle, which it might be expected to make. Now, when we use the word expected, it does not mean the actual, right? But the expectation, assuming there are certain conditions which are satisfied. If it were a distinct and independent enterprise, which means for a minute, in order to calculate this profits, assume that a PE is not an extension of the foreign company, but it is an independent company which is into existence, engaged in same or similar activities. What this means is that it is only for the activities which are similar in nature, right, to another enterprise which is a distinct and independent enterprise, right? Under the India-US Treaty, what you need to tax in India is the activities, the profits attributable to the activities in India, under same or similar conditions. The conditions could be as to the scale of business, right? The conditions could be as to the use of technology, the size of the business, right? So all these are basically, if you actually see, this is kind of a transfer pricing analysis that we are talking about. And why do I say that? Because in transfer pricing, what you do is you assume that the company is independent of its parent. When you find comparable, you look at companies which are engaged in same or similar activities. The conditions under which those comparable companies are operating are looked at to be similar to what our existing company is, and dealing wholly at arm's length with the enterprise of which it is a PE and other enterprises controlled by or subject to the same common control as that enterprise. So what you need to do here is, if there is a foreign company which has a PE in India, you for a minute forget that this is a PE. You say, okay, this is an Indian company, right? And which is dealing with the foreign company independently. Now, if it were independently operating, how would you find out what is the price which it should charge? That obviously is based on these factors, right? And the dealing or the activities for which this needs to be applied are the activities which the PE has with the foreign company, right? Normally the clause would end here. In some cases you may find part B, right? So when I say Part B, I'm referring to other enterprises controlled by, controlling, or subject to the same common control as the enterprise. All these transactions needs to be re-looked at to identify what would be the price which this ICO is the hypothetical one, the PE, would be charging if it were operating under these conditions. Now, when we talk about the arm's length price, I mean, it's not the maximum price, right? It is the price which would be charged between two independent enterprises who are operating independent of any kind of pressure or obligation to the other, right? In any case, where the correct amount of profits attributable to a PE is incapable of determination. This could be a situation where a company is into specific business, or what we require to carry out this analysis is not available, or the determination thereof presents exceptional difficulties. The profits attributable to the PE may be estimated on a reasonable basis. The estimate adopted shall, however, be such that the results shall be in accordance with the principle of this convention. Now, two things which one needs to note over here is that the onus to prove that the price is at arm's length is on the taxpayer, right? And this fiction to treat PE as a separate entity is only for the purpose of Article 7. But once applied, it not only applies to the profits of the PE, but it also applies to any profits which are attributed to the PE by virtue of application of force of attraction clause that we discussed earlier. So what is the basis of allocating profits? First thing is identify if a business is carried on through a PE in India. If it is, then there's a mandatory profit attribution in each state, right? And what is the basis? The basis is you assume that PE were a distinct and independent enterprise. It was engaged in same or similar activities, right? Under same or similar conditions and dealing wholly at arm's length with the enterprise of it's a PE and other enterprises controlled by or subject to the same common control as that enterprise. Now, you have to adopt a reasonable basis if profits cannot be estimated on a reasonable basis, and if by virtue of application of this provision, the profits which are being allocated are more than what they are under the domestic laws, go by the domestic law. But if under the domestic law the attributable profits are higher, then you can always opt for the provision of the treaty.